Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Tuesday, the 10th of December 2024. So as usual, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the latest intraday technical outlook on the various broad-based cross-asset classes ranging from FX to major stock indices, and as well as the two key commodities that we share on a daily basis, that is gold XAU/USD and West Texas crude oil, let's have a recap what has taken shape yesterday in terms of news flow, economic data release, and as well as their respective impact towards the broad-based cross-asset classes. So yesterday's most important economic data release is more pertaining to the China economy or the China stock market, and the proxy Hang Seng stock indices is where the China top policy maker ended yesterday's monthly political bureau meeting. All right, over here. So at the end of this political bureau meeting, they will always issue a statement, a broad-based statement or what has been discussed. So in this broad-based statement over here is that they change the tonality that is being worded in this broad-based statement for the December monthly political bureau meeting. All right, this political bureau meeting. So this political bureau meeting consists of top China policy makers. All right, not the tier 2, it's the tier 1, and chaired by President Xi himself. So it has a significant impact in terms of sentiment and in terms of how market view this statement that is being praised, or the faces of the statement, the praise, okay, the wording. So this wording over here, the readout, I will say the readout, all right, change the tonality of using moderately loose monetary position in 2025. All right. So previously in the last 14 years, they tend to keep this phrase called prudent strategy. Right. So a change of prudent strategy, let me highlight it. So it's bigger. A change in oops. Where is it doing? Okay, sorry. Think why is it? Yeah, this one. Okay, prudent strategy, a change of prudent strategy to moderately loose monetary position. All right, and what over here is that they also pledge more proactive fiscal policy. All right, so the key thing over here is that because of this change in tonality away from what is being used in the last 14 years of prudent strategy, ignite a what I call positive short-term animal spirits on the Hong Kong stock indices, because this particular policy statement is being announced towards around between 3 p.m. to 4 p.m. Singapore time. So that's coming always towards the end of the Hong Kong session, where the Hong Kong stock market reacted positively to this news flow and rallied very sharply on the Hang Seng indices, or the Hang Seng indices, which is up by more than 2% and stretched into the overnight US session in the futures market. So later I'll touch on what are the key levels to take note of. Still recall, for those who have followed my daily dose since late last week, because there's some positive sentiment on the Hang Seng index where we flip to a bullish bias. All right, so what's interesting over here is that this particularly moderately loose phrase was actually used also during the great financial crisis. And during this point in time in 2008 and 2010, the China top policy makers give the green light to actually kickstart massive fiscal and monetary policy stimulus to jumpstart the Chinese economy. And because of this change in phase, market reacted positively in the short term, all right, to this major Hong Kong stock indices or the Hang Seng indices. But nevertheless, on the background, the longer term horizon, there are things that yet to be settled, especially how will the market react and how the economic growth will react if Trump were to unleash his higher or additional 60% tariffs on Chinese exports to US, and also how the market will react if there were further tit for tat measures engaged by the China authorities towards US companies and US airlines, which has already started to play out yesterday. Okay, what do I mean by this? So, and yesterday during the US session, the start of the US session, China actually targeted NVIDIA. Okay, why NVIDIA? Because NVIDIA right now is one, the market darling in the US stock market that drives up the bullish momentum or the bullish optimism in AI related higher productive growth. All right, and we know that NVIDIA has a significant weightage in the S&P 500 and the Nasdaq 100. So if NVIDIA doesn't do well, it could create a negative feedback loop into the US stock market, which it did yesterday. Later I'll share you on the performance of the US market. So what it did over here is that the Chinese regulator actually now alleged that NVIDIA has violated this anti-monopoly laws around a 2020 deal. All right. So at that point in time, it actually regarding this acquisition about Mellanox Technology, right, which is part of a China-related company. So they actually this is the kickstart of a potential further tit-for-tat measures that could escalate into 2025. All right. So, and what's interesting over here is that China not only target US, it also target its airlines as well. So on the same time yesterday, it also announced cutting off drone supplies. So we know that China produce a lot of raw materials related to we call it highly sensitive equipment like electronic vehicle that is driving the future growth globally because of the climate change issue, and as well as drone, because we know that drones is now being used in modern warfare. And drone, in order to do the drones, China produced the raw materials for making drones, and right now China is cutting off drone supply critical to Ukraine war effort. So it's indirectly indicating to us that it's hitting the airlines of the US as well. Okay, giving a bit of what I call brinkmanship, or giving a warning sign to the incoming Trump administration that do not take us for granted. All right. So it seems to us if this thing continues to play out in the 2025 scenario, that could actually potentially hit the US economy as well. It could boomerang back, and market actually responded to that by giving a intraday sell-off on the major US stock indices. So you look at the major US stock indices yesterday, all of them closed in the red. All right, so the worst hit was the Nasdaq 100, like I explained why, because of the significant weightage of NVIDIA and other AI mega cap technology related stocks, where China opened up a probe into NVIDIA that kickstart this negative feedback loop. So Nasdaq 100 is down negative 0.8% or 0.84%. The SPX also down negative 0.61%. Even the Dow Jones and the Russell 2000, even though they do not have a significant weightage of mega cap technology stocks within their respective indices, they are also being dragged down by this negative feedback loop in the mega cap technology stocks, US technology stocks, triggered by the sell-off in NVIDIA yesterday, which where the Dow Jones was also dragged down by negative 0.5%, and the Russell 2000 is also down negative 0.7 or 67%. All right. So, and what's interesting over here is that we also start to see a potential, we call it sell-off in the treasury as well, US treasury. That means the treasury yield actually went up not went down. So what do I mean by this? So we know that treasury prices is going inverse with treasury yield. A push up in treasury yield represents a sell off in treasury prices. All right. So what you see over here is that the US treasury, the 10-year US treasury yield managed to find support at around the 200-day at this 4.16% for the 10-year. All right. So there is actually a bullish candlestick that actually take shape yesterday. All right, a bullish candlestick. All right, they're able to bounce off from close to the low that was printed on last Friday, okay, at 4.16. And if you look at the shorter tenure 2-year treasury yield, okay, this is a yield, not the price. That means a push up in treasury yield indicate that the bond price actually fall. All right, so the shorter tenure 2-year treasury yield, that means representing a 2-year bond price, and as well as also representing the US monetary policy as well, because the 2-year treasury yield track very closely with with the US monetary policy stances. So the 2-year treasury yield managed to bounce off from a key support level as well at 4.09%, okay, which is also close to the 50-day moving average and the previously congested minor swing high area of 16th of August and 10th of October last year. Breakout now turns into a pullback support level. So what it means, the bond market is telling us, the US Treasury bond market is implying us that next year potentially there could be higher inflationary trend coming into US as indicated by the 2-year Treasury bond yield is actually managed to find support at the 4.09% level, because potentially whatever plays out between US and China could be inflationary in nature. Yes, that means i.e. tick for tack measures among these two of them. That means imposing trade tariffs on one another and China imposing sanction on key materials that US required or even their allies required, okay, for critical political or strategic purposes. Okay, and that push up in the 10-year US Treasury yield also potentially indicating what I call a strategic shift of China may starts to actually offload or more longer term US Treasury bond, and they may shift their focus into other asset classes like gold. So that's actually explain why gold actually rose by close to about 1% yesterday during the US during upon the news flow that was released stating that there's a change in the China December ex post meeting statement issued by Political Bureau stating that they will engage in much more forceful stimulus plan both in physical and monetary heading into 2025. Okay, so that also explains why gold price rose by 1% as well. That means lower interest rate in China, given the fact that we now start to see heightened tick for tat measures coming into between US and China, potentially could head into 2025, and that also potentially lead to what I call a potential sell-off in US Treasury bonds on the 10-year side. That means they push up the 10-year Treasury yield, and this sell-off in the 10-year bond may also indicate what I call less allocation by Chinese government, or potentially they could be used as a weapon to push out longer-term trend in longer-term interest rate trend in the US, and that lead to what I call safe haven demand flowing into gold. Okay, so that actually explains why gold actually rose by 1% yesterday. Okay, so later I'll touch on the short-term technical outlook on gold thereafter. All right, so this is what has transpired yesterday. This key important data point that I will share with you, and this key important news flow, not data point, could actually stretch on not on the intraday basis for today. It could actually take on from a higher time horizon, because the strategic affairs between China and US may start to play out again next year, given that Trump's has already kickstart his so-called trade tariffs narrative by announcing that on his personal social media post 2 weeks ago, which I have already covered in my daily dose previously. All right, so now let us now take a look at one inter-market dynamics that could play out from a medium-term horizon. That means more of a multi-week perspective on the US stock market. All right. So this particular intermarket dynamics on share with you is more on the market breadth of these two key major US stock indices, which is the Nasdaq 100 and the S&P 500. So this dark blue line and dark yellow line, the dark blue line is the percentage of Nasdaq 100 stocks above their 20-day moving average, and the dark yellow line is the percentage of Nasdaq 100 stocks above their respective 50-day moving average. So what we could see over here is that both the percentage of Nasdaq 100 stocks above the 20-day and percentage of Nasdaq 100 stocks above their 50-day is not rising in the last week or so. Okay, instead it starts to decline. All right, let me put it in. Okay, it starts to inch downwards. Okay, representing a lack of positive market breadth in the Nasdaq 100, right? Okay, so now I'm looking at the percentage of stocks inside Nasdaq 100. All right, so what it means that I'm looking at a bigger picture rather than, you know, that if Nasdaq 100 is market cap weightage. So if only a few stocks that manage to rally, like Nvidia or like Meta, Amazon, that has higher weightage inside the Nasdaq 100, yes, they may lead the index higher. But however, as a whole, if on a percentage basis, if there are not lesser stocks that are trading above the 20-day moving average or the 50-day moving average, it indicate a not so bullish market breadth scenario, as this push up in the Nasdaq 100 is being held up by only a couple of handful of top 5 market cap stocks, whereas the 95 stocks in the Nasdaq 100 is not showing similar bullish momentum as the top 5. So this is what I'm trying to share with you based on this market breadth indicator of the percentage of Nasdaq stocks trading above the 20-day moving average and the percentage of Nasdaq 100 stocks above the 50-day moving average. So instead of trending higher, they trend lower since last week. Okay, trend means it actually inch downwards. And the one that is trending more pronounced downward is the percentage of S&P 500 stocks holding above their 20-day moving average. So this is the turquoise blue, and as well as the light green over here, which is the percentage of Nasdaq 100 stocks above the 50-day. So what it means that, yes, the top 5 stocks in terms of market cap may be pushing the S&P 500 to all-time high, but the remaining 495 stocks is not so rosy and does not reflect similar bullish momentum, by an indication that there are lesser S&P 500 stock in terms of percentage that are trading above the 20-day moving average, and it starts to decline last week to below as of Monday, yesterday, because this end of day prices, as of Monday, only 42% of them are holding above their 50 to 20-day moving average. So despite the S&P 500 stocks that are still holding above the 50-day moving average, above the 50% mark, but it has started to decline from 69% to 57% as of yesterday as well. Right, so it's also inching downwards, okay, not inching upwards. So based on this market breadth metrics, as I share with you all, on the percentage of stocks holding above their respective 20-day moving average in terms of percentage, and their respective 50-day moving average in terms of percentage on the S&P 500 and the Nasdaq 100, represents that it's not so healthy in terms of market breadth. That means, i.e., from a medium-term perspective, that means multi-week perspective, the S&P 500 and the Nasdaq 100 could be potentially shaping a multi-week corrective decline within its major uptrend phase that is still intact. So that means in the short term, there could be much more higher chances of bearish corrective pullback scenario unfolding rather than impulsive up move to kickstart a fresh new all-time high on the S&P 500 and the Nasdaq 100. So bear in mind, I'm not saying that we really hit a major top formation on the S&P and Nasdaq 100, but rather, at least from a we call it market breadth perspective, or a multi-week perspective, market breadth translating to this multi-band matrix, translating into a multi-week perspective, it could actually shape that multi-week corrective decline on these both indices but still holding within their multi-month major uptrend phases that is still intact based on their respective technical chart. All right, so this is the intermarket dynamics on share we have for today, more pertaining to the US stock indices. Now, let us now have a deep dive into the intraday technical outlook on the various broad-based cross asset classes. But as usual, let me expand my screen so that you guys have a clearer visualization on the charts. So let us start with the FX market first. All right. So on the euro dollar, so the euro dollar, no change. Yesterday, it actually tried to rally, tested the 1.06 short-term pivotal resistance, come break above it and traded lower in the entire US session. Okay, so 1.06 is indeed a short-term pivotal resistance on the euro dollar that to maintain that intraday bearish bias. So right now is about to revisit the 20-day moving average again, which is the downside trigger level of 1.0530 that we have predefined on last Friday and yesterday as well. So right now, if we have an hourly close below 1.0530, the odds will increase for this bearish biasness, not bullish biasness. The odds will increase. I repeat again, for the bearish biasness on the euro dollar to expose the next near-term support level at 1.0460. All right, so these are the two support levels to watch out for today, 1.0530 and 1.0460. Only a push out and an hourly close above 1.06 will invalidate today bearish bias on the euro dollar to kickstart a potential extension of the mean reversion rebound scenario that has taken shape since the low of 22nd of November, exposing the next near-term resistance zone of 1.0660 slash 1.0680. Above it potentially sees 1.0770 next. So that's for the euro dollar, still using 1.06 figure short-term pivotal resistance level to maintain the bearish bias. Turning our attention now will be the sterling dollar. So no change, the sterling dollar continues to evolve. Yesterday it actually went up, almost hit the upper neutrality zone that we highlighted earlier on yesterday as well, which is also confluencing closely with the 200-day moving average, acting as a resistance at 1.2810. So still no change, still using these two key levels as a neutrality zone on the sterling dollar, 1.2810 and 1.2690. Only a breakdown below 1.2690 with an hourly close below it we will revert back the bearish biasness on the sterling dollar to expose at least the near-term support level for today at 1.2610. Only a push up above and hourly close, a breakout with hourly close above 1.2810 reinstate the mean reversion rebound scenario on the sterling dollar, exposing the next near-term resistance level at 1.290. Above it sees 1.2 or 1.3 figure level next. Okay, let me put it in writing. Okay, so that's for the sterling dollar. All right, so now turning our attention will be the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar, as you are speaking right now, around 6 more minutes, we will see the outcome of RBA decision. Okay, so just have a quick look at the calendar. So RBA will be announcing its interest rate decision at 11:30 a.m. Singapore time. So that's about 6 more minutes from now. Market is still looking at no change at 4.35%. So very unlikely it will actually cut interest rate. Okay, because it has been maintaining interest rates since almost about 6 to 8 consecutive meetings. The only loan developed central banks other than BOJ is an outlier that hasn't cut interest rate at all. But market will be focusing on the monetary policy statement and as well as RBA Governor Michelle Bullock press conference that's out at 12:30 p.m. And there is actually a high chance that she will actually tone down her very strong, staunch, hawkish rhetoric that previously keeps saying that Australia still faces the risk of elevated services inflation, but she was skewed more towards recession fighting mode, given the fact that last week Q3 GDP from Australia actually disappoint. All right, so the market also seems to be expecting that as well. If you look at the Aussie dollar yesterday, it actually did a bit of whipsaw above our 64.50 level. That was due to the Chinese we call it a political bureau ex-post meeting statement, which I highlighted earlier on, which is sounding very dovish. But unable to maintain the upside momentum and traded back below 64.50 level. All right, so keeping a bit of excess yesterday. So where it got rejected as well, it got rejected at the downward sloping 20-day moving average as well, indicating that the short-term downtrend still remains intact on the Aussie dollar. So I have a excess above 64.50 yesterday, using 64.80 as my excess. So short-term pivotal resistance level. So may still maintain that intraday bearish bias on the Aussie dollar. A breakdown below 64 figure level exposes 63.60 next. So 63.60 is very crucial. So 63.60 is in fact the lower limit of a major support zone that I previously keep on highlighting for those who have followed up daily dose. So this is being defined on the daily time frame chart, 63.60 level. Why is it important? Because 63.60 level previously managed to survive on the 5th of August, 18th of April, and as well as 26th of October last year, that previously led to multi-week rebound, where price action of the Aussie dollar since 13th of October 2023 lows got congested in this major kind of sideways, complex sideways range configuration. So if we manage to have a daily close below 63.60 and more importantly a weekly close below 63.60, that would increase the odds to kickstart a potential multi-week to multi-month impulsive down move sequence on the Aussie dollar, because that represents a clear bearish breakdown with a weekly close below 63.60 after close to 1 year plus of major sideways range configuration. A complex side range configuration. So these are the levels to watch out for on the Aussie dollar. But however, if the Aussie dollar managed to surpass 64.80 thereafter, then this bearish bias will be totally invalidated on the intraday basis to see a further squeeze up towards 65.10 followed by 65.45 next. All right, so that's for the Aussie dollar. So now turning our attention will be the dollar yen. So oops, let me expand my chart again. All right, so the dollar yen also failed to actually make any hit ups on the 50-day moving average, still continue to act as a resistance level. All right, and right now after that, what we could see over here, there's actually a bearish divergence that has already been formed on the start of today's Asia session. Right, there's this bearish divergence here where price action of the RSI shaped a lower high at the overbought level, and now it's already exit from the overbought level, despite the fact that in today's Asia session it got actually a push up right above our pivotal resistance at 51.20, but can't make any breakthrough. Then thereafter it got rejected and the bearish divergence took shape on the hourly RSI. So what it means that it indicates to us a kind of lack of upside momentum to see any potential positive follow through. So with that, I have a bit of excess for today. Today's current intraday high is at 51.55 and also correspond close to the 50-day moving, exactly at the 50-day moving average as well, that got rejected and shaped that bearish divergence on the hourly RSI. So with that, I will have an excess of 55 level for 51.55 for today as my short-term pivotal resistance level, maintaining that bearish bias momentum at least on an intraday basis. First support level to watch will be 150.60. A breakdown below it exposes last Friday minus swing low at 149.60 next. Okay, so these are the two key support levels to watch for today. 150.60, below it exposes 149.60. However, if there's a price push up above 151.55, your hourly close above it, then this intraday bearish bias will invalidated to see the continuation of the push up to expose the 200-day moving average, which confluencing with the next near-term resistance zone at 15190/15215 next, right? And also correspond very closely to this upper limit of this minor descending channel that is in place since 15th of November 2024 minor swing high. Okay, so that's for the dollar yen. Okay, so with that, that also sum up the intraday technical outlook on the major dollar FX pair. So now turning our attention now will be the major stock indices, starting with the Hong Kong 33. So Hong Kong 33 yesterday, we see this sharp rally on the Hong Kong 33 up upon the announcement of the post-meeting political bureau statement. All right, so it hit a sharp rally, hit our resistance level. Okay, then thereafter during the close of the Hong Kong Stock Exchange, which is at 4:30 p.m. Singapore time, the futures continues to rally as well, which actually translate to a further push up on the Hong Kong 33 index, because our Hong Kong 33 index, CFD index, actually take the cue from the Hang Seng futures that is still trading during the European session and the early part of the US session yesterday. All right, there's a continued push up over here. And now what we could see over here is that the pullback take shape. So this pullback is pretty much what I call it nature. Why? Because after a sharp push up over here, it will tend to lead to a pullback, at least a intraday pullback scenario after the RSI hit a grossly overbought level. And what's interesting over here is that this pullback right now actually managed to actually come close to its support. Its previously resistance zone now turns into a pullback support level. We also correspond to the 50-day moving average as well. And if you would do the Fibo retracement of yesterday's rally all the way up to this intraday high, it corresponds to the 50% and the 61.8% as well, which is the 20,490, 20,490, 20,150 zone. All right, so I have a slightly lower level of 20,150 as my short-term pivotal support level, slightly below this zone here, just to, in case of any potential whipsaw. So as long as this pullback didn't surpass below 20,150, we will still maintain that intraday bullish bias on the Hong Kong 33. First resistance level to watch will be today's intraday high, or not today, will be yesterday's US session intraday high at 21,350 level. 21,350 level, followed by the next resistance at 21,610 level. All right, so we also correspond to this minor swing high area of 10th of October. And as well as if I do the Fibo extension of this rally move, it also correspond to the 2.618% very closely at 21,750. Right. So, however, if the price action starts to break down below 20,150, then we will see another round of choppy movement again unfolding on the Hong Kong 33. In first step, it may expose the next two support level to watch, 19,940 first, followed by 19,960, which correspond very closely to the 20-day moving average, and as well as the minor swing low of 6th of December, which is last Friday low, and also correspond to the ascending trend line support minor one from the low of 26th of November. Okay, so that's for the Hong Kong 33. Now, turning our attention will be the Japan 225 or Nikkei 225. Still no change, continues to be compressed inside the neutrality range of 39,480 level. Okay, price action still can't break above this minor descending trend line that I drew from the minor high of 4th of December. And at the lower limit is still being supported by the 20-day moving average and the 50-day moving average, and as well as this minor ascending trend line support from the low of 28th of November, which is our lower limit of the neutrality range at 38,830, 38,670. So still no change, still maintaining that neutrality stance between 39,480 and 38,630/38,670. Okay, as price action get congested within this neutrality range. Okay, so that's for the Japan 225. Okay, turning our attention will be this German 30 or the German DAX. So the German DAX, yesterday we still maintain our intraday bearish bias that we have off from last Friday. 20,470 as my short-term pivotal resistance level. It didn't actually surpass that level, almost retested it at the start of the US session before trading much lower. So it managed during, because Asia session now is rather illiquid over here. So I do not really consider this as a direct break below 20,310. So we got to see at the start of the European session at around 3 p.m. Singapore time, whether the momentum can still remains, whether the price action can still remains below 20,310 thereafter upon the opening of the European session. So if it could, then potentially the odds will start to increase for this bearish bias to persist on the German 30, holding below the 20,470 short-term pivotal resistance that we have since last Friday. Next near-term support level to watch will be at 20,155, followed by 20,010 next, as this minor corrective pullback potentially plays out. However, if price action starts to surpass with an hourly close and a breakout above 20,470, the bearish bias for this minor corrective pullback sequence will be invalidated to resume the impulsive up move of the German 30 to visit potentially the next resistance level at 20,650, followed by 20,845 next, as defined by a series of Fibo extension level. Now, turning our attention will be the US major stock indices, starting with the Wall Street 30 or the Dow Jones Industrial Average. So the Dow Jones Industrial Average yesterday broke down below our short-term pivotal support level at 44,520. So with that, price action seems right now, after failure to break above 45,050, which is the upper limit of this minor ascending channel, okay, that I drew from the low of 5th of August over here. Okay, in fact, it's a medium term because it's already more than 1 month, a medium term ascending channel from the low of 5th of August 2024. That represent potentially a start of a minor corrective mean reversion decline scenario unfolding. Potentially, it could actually head back down towards the 50-day moving average, which is very close to the lower limit of that medium-term ascending channel from the low of 5th of August. So taking things one step at a time, using yesterday's pin high or the minor swing high that got rejected on the previous minor swing low, turns into a pullback resistance at 44,740. So using 44,740 as my short-term pivotal resistance level on the US Wall Street 30, flip to a intraday bearish bias for this minor corrective decline sequence or mean reversion decline sequence to play out. A breakdown below the 20-day moving average now acting as a key near-term support at 44,350 exposes the next near-term support zone of 43,980 slash 43,807 next. However, only a hourly close and a push up above 44,740 will negate the bearish bias to see a invalidation of the, we call it the mean reversion decline scenario, and potentially kickstart a recovery, at least a retest on the current all-time high area at 45,070 in the first step. Okay, so that's for the US Wall Street 30. Now, flipping our attention will be the Nasdaq 100. So the Nasdaq 100 yesterday, we have a first resistance to watch. It will be at 21,650, followed by 21,770. So yesterday, we do maintain that bullish bias that we have from last Friday. So price action, yes, at the European session managed to actually hit the first resistance level, but at the start of the US session over here, it can't maintain that bullish momentum and starts to trade lower. So upon hitting the new higher high at the start of the European session, which is our first resistance at 21,650, price action on the RSI shaped that bearish divergence. So with that bearish divergence and the failure to see any meaningful breakthrough above 21,650, indicate potentially the start of a minor corrective decline or a mean reversion decline in the first step, to see it floating down back towards the lower boundary of this minor ascending channel that I drew from the low of 20th of November. And also potentially it may go further to hit the 20-day moving average, I think, as a support at 20,970 next. All right, so taking things one step at a time, using 21,650 as my short-term pivotal resistance for today, flip to a intraday bearish bias for that potential mean reversion decline scenario that may play out on the Nasdaq 100, which I highlighted the negative intraday negative short-term technical elements earlier on. A breakdown below 21,400, that was yesterday's short-term pivotal support level, will increase the odds of this mean reversion decline scenario. Next near-term support level to watch on the intraday basis will be 21,220 level. All right, 21,220 level. However, if price action starts to have an hourly push up and a close above 21,650, today's intraday bearish bias will be invalidated to see the continuation of the impulsive up move for fresh all-time high for the next resistance to come in at 21,770, which is a Fibo extension cluster level, 0.618 and 0.382 from different degree of a swing low. Above 21,770 exposes 21,950, 22,003 6 nicks, 22,036 nicks. All right, so that's for the Nasdaq 100, and also sum up the intraday technical outlook on the major stock indices. Now, turning our attention will be the so-called what's it, the commodities market, pardon me. So let us start with the gold XAU slash USD. So for gold XAU slash USD, price action broke through the 50-day moving average and also the 2,666 short-term pivotal resistance that we have on this range configuration that we have since the low of 26th of November. And what you see over here is that the hourly RSI staged that bullish breakout. Okay, the bullish breakout hit tested right now during the Asia session. All right, it pulled back during the Asia session, early Asia session, and now it staged that rebound upon retesting that pullback support line on the hourly RSI, indicating some form of minor bullish momentum that has came back into the gold market XAU slash USD. So with that, I will use a key short-term pivotal support for today, which is at 2,645 level. Okay, 2,645. So this 2,645 is in fact this level here since last Friday got rejected, and since early Asia session morning it got rejected and only managed to do a positive breakthrough upon the release of that China Political Bureau post meeting statement coupled with the tick for tat measures, we call it triggered by China regulators towards US and towards US airlines. Okay, that saw gold price to push up its momentum. And using that as my short-term pivotal support level for today, 2,645. As long as any minor pullback that we're able to contain above 2,645, we will flip to a intraday bullish bias on gold XAU slash USD to see a minor recovery in first step. Next resistance will be at 26890. Above it exposes 2728 slash 2715 next. Only a hourly close and a push down below 2645 will invalidate today's intraday bullish bias further recovery scenario to reintegrate back into this rather complex minor sideways range configuration again, revisiting the range configuration support level at 2622. Below it exposes 2600 slash 2590 next. Okay, so that's for gold XAU slash USD. Flip to a bullish bias due to a positive element that's being seen on the hourly RSI, using 2645 as my short-term pivotal support for today. Now, lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we do have a bullish bias. So the bullish bias almost hit our resistance level at 69.30 and it got rejected, right, at the 20-day moving average, acting as a resistance level. So with that, we will flip to a neutrality stance for today on West Texas crude oil. So neutral between 69.30 and 67.10, where that was the low of last Friday, where the rebound took shape yesterday. So if price action have an hourly close above 69.30, then this potential mean reversion rebound scenario may extend further to revisit the 50-day moving average, also acting as a resistance at 70.80 next. Okay, so flip to a neutrality stance between 69.30 and 67.10 for now on West Texas crude oil. All right, so before we go, let's have a quick look at the economic calendar. All right, let me refresh that. Okay, so no change on the interest rate decision for RBA at 4.35%. So let's see how's the price action of RBA looks like right now, of the Aussie dollar looks like right now. Okay, so so it actually broke through the 64 figure level. So next key support level to watch within our expectation will be at 63.60. All right, so now other than RBA, the next thing to watch out for is 1 hour later at 12:30 p.m. all right, which is the speech or the press conference of RBA governor. All right, why is it important? I already explained earlier at the start of today's daily dose session. And during the European session over here, nothing much key, because this inflation rate is the final rate of Germany, so shouldn't be a big surprise. Okay, because the preliminary figure was released about 1.5 weeks ago. Okay, no clear, yeah, there's no other key economic data to look out for during the US session and the European session thereafter. And the next thing to look out for in tomorrow Asia session, more pertaining to the Nikkei 225 or the Japan 225 and the dollar yen FX rate or even the yen crosses, will be economic sentiment data of the Japanese business firm, as compiled by Reuters Tankan. They call it a Reuters Tankan index for December. So it's more of a business sentiment index for Japan. That is out at 7 a.m. Singapore time. And also pertaining to the inflation outlook of Japan will be factory gate prices that have an impact on consumer inflation. They call it the producer price index. That is out at 7:50 a.m. Singapore time tomorrow. Right. So that's sum up today's daily dose of market insights. Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.